All right, welcome to Talk Tickers. Today we're diving into one of the most confusing earnings reports of the quarter, Dollar Tree's Q2. It's a really strange story where fantastic numbers meant a really bad day on the market.
So, right out of the gate, the numbers looked amazing. The company reported adjusted earnings of 77 cents per share. That absolutely crushed Wall Street's estimates by a whopping 35 cents. I mean, that is a huge beat.
And hey, it wasn't just the earnings. Revenue also came in hot, beating expectations by $90 million. So, based on the headlines, you'd think this was a fantastic day for the stock. But it wasn't. Not even close. Instead, the stock got absolutely hammered, closing down more than 8%. So, a big beat on the top and bottom line, and the stock just tanks.
So what gives? What on earth did the market see that the headlines completely missed? Let's unpack this puzzle.
Okay, so first, let's actually look at that good news because you've got to give credit where it's due. This quarter was, on paper, really strong.
I mean, just look at this table. We're talking about a clean sweep right across the board. A huge beat on earnings, a solid beat on revenue, and a really powerful beat on comparable store sales. They came in at 6.5% growth when the street was only looking for 4.9%. And this wasn't some fluke driven by just jacking up prices. No, this was the good stuff. It was an almost perfect 50-50 split between more people walking in the door, that's traffic, and those people buying more stuff, that's the ticket. That's the dream scenario, really. And get this, they're pulling in new shoppers. We're talking 2.4 million new customers. But here's the real kicker. Nearly 2/3 of them were from households making over $100,000 a year. That tells you their value message is hitting home with a much wider audience than you might think. So the quarter itself was great. But on top of that, management was making some seriously smart moves that, honestly, on any other day would have probably sent the stock flying. I mean, just look at this timeline. It's pretty wild. In just one single quarter, think about it. They finally sold off Family Dollar to focus the business. They greenlit a massive $2.5 billion share buyback, and they launched a nationwide deal with Uber Eats. We're talking huge, decisive, shareholder-friendly moves. And the CEO, Mike Seaton, he basically spelled it out for everyone. He said, look, we are a fully focused business now. Every bit of attention, every single dollar is going into the core Dollar Tree brand. That's the kind of simple, powerful story investors usually eat up. Okay, so we've got a fantastic quarter. We've got a smart, focused strategy. So where did it all go wrong? Well, the entire story, the whole reason for that 8% drop, it all comes down to just 20 cents.
And that 20 cents comes from something the company called tariff timing. Sounds a little technical, right? So what in the world is it?
Think of it like this. It's a temporary accounting quirk. It's basically a timing mismatch between when the company has to account for the costs of tariffs and when their price increases to cover those costs actually show up at the register. The result? You get this artificial short-term profit boost that's really just been pulled forward from the future. And this right here is the heart of the whole issue. You see that big 35-cent earnings beat they had? Well, about 20 cents of it was thanks to this tariff timing benefit. And the market, which is always looking one step ahead, saw it instantly. They knew that 20-cent tailwind in Q2 was going to flip right around and become a 20-cent headwind in Q3. And that's what freaked everybody out.
So, putting all of these pieces together, where do we land on the stock? Let's break down our call and what we're watching.
When you look forward, it's really a classic Wall Street tug-of-war. The bull case? It's strong. You've got the new multi-price strategy rolling out, they're grabbing market share, and the business is way more focused. But the bear case is just as powerful. You've got ongoing tariff worries, rising costs, and a pretty cautious outlook on their core lower-income customer. So if they want to get that investor confidence back, the road ahead is pretty clear. Number one, they've got to get through this Q3 earnings reset from that tariff mess. Number two, they have to keep pushing forward on converting their stores to the new multi-price format. And finally, they have to prove to everyone they can handle these costs and deliver a solid holiday season. So our official call here is market perform. Look, the long-term strategy is solid, no doubt about it. The business is in a much better place without Family Dollar, but this stock is probably going to be stuck in the mud for a bit, likely trading sideways until Wall Street gets a much clearer picture of what their profit margins are going to look like heading into next year. And as always, this is not financial advice.